Hey guys, this is Lane with the Simple Passive Cash Flow Podcast. I got a short talk today on cost segregation. It's been talked a lot about recently, and I wanted to bring my buddy John Collins on the line. Hey there, John.
Yeah, hey Lane, how you doing?
Hey, so John's in my one of my mentorship groups, and one of his side gigs is cost segregation. He's the expert in it, and I thought we'd instead of me just talk about these concepts, I thought I'd bring the expert on the line. So John, maybe kind of talk us through what's the cost segregation? How does it get us at those tax savings?
Yeah, sure. So I think most people here listening probably are aware that depreciation is a really nice lever for most real estate investors. That's one of the four or five ways that people mostly talk about that real estate puts money in their pocket. But what a lot of people aren't aware of is that cost segregation is basically like depreciation on steroids. It just takes it down another level and can accelerate a lot of those tax savings in the early years of ownership. So that's basically what cost segregation is. You're taking your depreciation a lot sooner than you would otherwise.
All right, and the way that you guys do that is, it's not the CPA doing that. It's an engineer or architecture firm going in and kind of slicing up the property into more components, which are then line item, and some things are depreciated a lot quicker, some things longer, but overall it's more than just kind of the blanket 27 and a half years or 39 years deduction.
Right, exactly. I mean, typically a CPA can do the basic depreciation calculation, which is the building less the land value. But then once you go beyond that, it's pretty unlikely that they can go much farther than maybe some basic appliances and a few other things, because the IRS actually requires someone who's got construction experience, engineering background, or architecture background to come in and do the actual cost segregation study, which is a much more thorough, much more detailed look at the building and separating out all the different components into the different depreciation schedules. So an engineer, they're going to be familiar with construction drawings and the different cost base of the costing schedules used across the industry that are recognized by the IRS. And, are they actually following the guidelines that the IRS puts out for cost segregation, the tax audit techniques? And that is basically kind of a roadmap for putting together this information in a way that's recognizable by the IRS and immediately puts tax savings in your pocket as the investor.
Yeah, and this is kind of called bonus depreciation too. I think that's kind of the buzzword going around, and it's a little misleading. um, the depreciation, you with this cost segregation, you can kind of front load it, and it's not really like you're getting more deductions. You're just getting them earlier in the pay schedule instead of taking it, throughout the 27.5 years or 39 years evenly. You can front load it a lot of times, especially with the new tax laws, and get a lot of it in those first few years, which, as investors, we always look at the time value of money. So it's kind of getting your deductions up in, sort of year one in our example that we'll go through, and instead of, in the future. So it kind of is money in your pocket, but technically you're going to get the same amount of deductions.
Yeah, I mean, there's a number of reasons why cost segregation would be advantageous for a property owner. A lot of times when you acquire a property, the first year or two of holding it, you're going through a stabilization period depending on what your business strategy or model is. So being able to relieve some of that financial pressure in the early years is a really nice tailwind for a lot of people, if they're going to be doing upgrades or maybe the building's partially occupied or whatever. So being able to take those deductions earlier versus having to wait for them can relieve up a lot of financial pressure in the early years. And then also, I mean, the time value of money, like I think we use a 5% net present value calculation to show like the discounted value um, by taking that money sooner versus waiting, to get those deductions later on. So, just like what your strategy is, some people, they really want to fine tune and dial in their financial picture and get their dollars working as hard as possible. And this is one way to really do that.
All right. And as a limited partner, you know, that's one of the reasons why you go in on a big deal, because at a certain point, these things are, they're they're more of a big item, you know, big property item to kind of start doing it. What would you say kind of the cutoff is, John, that, you know, because these cost segregation studies, I mean, they're kind of cheap. They're like, you know, 3, 6 grand. What's kind of the cutoff in building size that these things kind of make sense?
Yeah, that's a great question because I run across a lot of people that they've heard of cost segregation, they're familiar with it, but they just think that it's only for really big buildings, really big commercial buildings, and it can't apply to any smaller stuff that they might hold in their own portfolio or maybe a smaller deal that they're investing in on the side. And that's really not the case. I think where some of the confusion comes is there's actually 6 different IRS approved cost segregation methods, and those methods they vary very much in terms of level of detail. So, like the method that our company uses, we actually use the 2 most detailed methods, and we're able to get down like in the nitty gritty. I mean, we're looking at studs, we're looking at nuts, bolts, like as low of detail as you can go, and that allows us to get down to building values that are about $200,000 and up. We can make the numbers work pretty well. And we don't even engage a client unless we can guarantee at least a 300% return on their service fee that they're paying us. So in order for us to keep our margin and keep our service guarantee in place, about $200,000 is as low as we can go typically. I've seen a couple that are a little bit lower, but generally we say $200,000 to be on the safe side. And then the higher up you go on value, it just accelerates. Usually once we break the $1 million property value, that's when the client really starts to see a ton of yield on their service fee because it's not proportional. It doesn't take as much. You know, for about the same amount of cost, we can get a lot more tax benefit for them.
Right, right. So for your little turnkey rental, it probably won't make sense, but you know, definitely on the bigger stuff. I mean, these things are free estimates you guys give, and we'll give out your guys' information after.
Yeah, so I think one thing, a lot of people that are, you know, like 1 to 40 unit owners, they don't think that they are in the running for benefit from cost segregation. But you know, a duplex, triplex, fourplex, in most cases, in most markets, we can make the numbers work on that.
Right. And another thing that makes sense, if you're more of one of those like legacy buy and hold investors that keep it, the longer you keep it, the more it makes sense.
Right.
So this is the K1 form for a lot of, you know, limited partners in deals. You know, all you really care about are the 2 lines. The number one, the ordinary business income, and then I think it's number 2, the business losses, and that's where the depreciation will come on. And in the form, you'll also get that bonus depreciation, as people call it. And you know, this is that cost segregation. So if you're going into a deal, I would always ask, hey, you know, just double check, hey, are you guys doing a cost seg on this thing? Because it just makes sense, and that's kind of why you're going on a bigger deal, so you can take advantages of its size and get economies of scale. But here's one of the buildings that John ran for me on my 52 unit. It's a $3 million purchase price or value. So you can see on there on the top line, he kind of did this for us for free on this estimate. He can probably do one of these for you guys. You know, the building costs were like 2.6 million, and I guess you guys figured like the land was, you know, 400 grand. I mean, it was out kind of in Iowa, so I guess the land isn't worth very much out there. And then you kind of showed us here that, you know, the fee is on the right side. So, you know, these cost segregations are not free, but, you know, they're relatively cheap. And those are the cost savings that you figure that we would get in other and highlighted. So in the first year, we'd see $130,000 based on pretty regular, or the 40% tax bracket, right? That's kind of how you guys figure that. And here is how that kind of got broke down over the years. I know it's small. You may have to pause the video and zoom in here. But if you look at the left highlighted side here, just to the left of it, that would be the normal depreciation schedule, how we would be deducting about $94,000 every year for 28 years, 29 years or so. And what the cost segregation would do with the new tax laws is that we'd get the bonus depreciation after in year one. And that's really front loads those deductions.
Yeah, if you don't mind, I'll jump in. I mean, bonus depreciation is really quite amazing. So cost segregation is already taking your normal depreciation and making it faster. And then bonus depreciation is just ramping it up even faster. And in most cases, the items that you're segregating out, you can depreciate the entire 100% of the value in the year you buy the building, i.e. put it into service. And that's huge. It's basically taking stuff from a 39-year depreciation schedule to a 1 year, which is like, that's just amazing. So that's kind of the essence of what bonus depreciation is. And this year is like the first year we've had 100% in a while, and basically you can depreciate it all in the year that you acquire it. So that is huge.
Right. So, one thing to point out, it sounds really nice, but if you're only holding onto the property for 5 years, you've got you got depreciation recapture in 5 years. But in a way, it's like you're getting a free loan for that big, you're getting the depreciation, you're getting the tax write-off. It's in a way you're getting that as like a tax-free loan for however long you own the property. So.
Exactly.
And I think we want to go over a few examples here. Maybe something off the top of your head, John, to kind of bring this to life that you've recently found in your travels.
Yeah, so I'm in the middle of a project right now with a client. It's going to be a $3 million acquisition, roughly. And just to give some real quick numbers, they are looking at over a $266,000 tax credit here in 2018, based on that building at that purchase price. And what the cool part is, the buyer has been in negotiation with the seller, and they've been a couple $100,000 apart on a purchase price, but by them doing cost segregation here right upon acquisition, they're going to basically allow them to step into this building for about the same price that they were originally negotiating for. So cost segregation is almost like an instant rebate in this example.
Yeah, so I mean, this is kind of the reason why these cost segregations, they're pretty cheap. They range from about $3,000 to $6,000 most cases. And I don't know if you guys, John, did you used to play video games when you were a kid, like Gran Turismo or anything like that?
I played some Atari and some Nintendo. If that kind of dates myself, I don't know, but
So, I mean, there's this game out there when I was a teenager called Gran Turismo. It was a racing game where you souped your car up, and you race and you get money. One of the upgrades on these cars was this dinky little computer chip that was like $1,500. Where all these other upgrades are like thousands of dollars. The computer chip is kind of like this cost segregation thing. It's like a no-brainer. Like, why would you not pay this small amount of money to get this big bump? Um, it's just that's what I kind of see it as the no-brainer. I don't know why don't people do this more often? Like it just doesn't make any sense to me. Why you would.
yeah, there's a couple other benefits too I want to share with your audience. So actually, the IRS would prefer that you do a cost segregation because it's a more detailed approach to the whole accounting of the asset. So basically, once a cost segregation study has been done, you're actually less likely to get audited. And in the event that you would be audited, you're actually can rest assured that your documentation is that which it should be. Versus, we have a lot of clients that come on and we'll take a look at their existing property, their existing tax asset detail, or their depreciation schedule. And in most cases, like we do a lot of corrections. Like it's pretty rare we find existing depreciation schedules that have been done correctly up to this point. So that's one thing. The outcome of a cost segregation study is like we get all that cleaned up and sorted out. And that becomes like another layer of value for your property, especially when you go to sell it, because now you can pass that information on to the new buyer and they can kind of pick up where you left off versus, having depreciation schedules that are incorrectly and done, kind of willy-nilly, which is what we see almost all the time. It's amazing. You'd be so surprised what we see from, professional CPA firms that just haven't done it correctly or didn't put a lot of thought into it. And really, that's what the risk is from the audit is if they were to look at some of these existing depreciation schedules that haven't been done correctly and don't have the level of detail. So that's just another reason that it's a good practice to have.
All right. And a lot of these, it doesn't make sense why a lot of these CPA firms wouldn't go out and have their client do this, but I guess from their point of view, it kind of makes things a little more complicated. I mean, they're not really getting any revenue from bringing you guys on. It just kind of makes their job a little bit more of a headache. So I think as the client or and even as a limited partner on a deal, you might want to tap the shoulder of your lead saying, hey, are you guys getting a cost seg done? Hey, here's John's number if you aren't.
Yeah, exactly. And I've heard different reasons why the current situation might be. I mean, I've heard that when CPAs are going through their training, like they don't even spend much time on the cost segregation topic because like one reason, like they're just not coming out of the schools with that level of knowledge or insight. And then the other big distinction is that, to do a cost seg study, you have to have construction, engineering, or architecture background. And it's pretty rare you find a CPA that has either or any of those credentials. So there's just kind of a natural divide there. But on the other end of the spectrum, you have folks that are very sophisticated and they've partnered up with firms and they have cost segregation studies done all the time. It's just part of their normal standard practice. But that's generally not the case for most people I see. It's kind of they're either on one end of the spectrum or the other, and we're trying to bridge that gap and provide education and let people know that there's quite a bit of benefit out there that could be taken advantage of.
Right. Yeah, and just something to think about for limited partners out there. You're going to get a K1 back. A couple of my deals I bought in the later part of the year, we did cost segregation on and we didn't make any money because a lot of the deals, it takes like a quarter or two to start seeing the cash flow after stabilizing the deal, even if it is a stabilized property. But we got, because we did the bonus depreciation and a big chunk, I mean, I saw a few $1,000s of depreciation just for like 1 month of ownership the previous year. So it's real stuff, and I don't know how it works. I mean, you have to talk to a CPA how it works, how that depreciation cancels out the income on that K1 if it rolls to your personal, if you didn't have any income on that individual K1 or that deal. Something to think about moving forward and ask the CPA. I've gotten different answers when I ask the CPAs. When I ask them that question, they kind of look at me with the crossed eyes. The ones that go to the local RIAs that I kind of just try and stump them with this question. Different things. So make sure you got a good one and and make I guess understand what they're trying to do here. I mean, a lot of times you're the limited partner, but you're the client, and you definitely have to let them know what you want done and kind of know what's fair. If not, they'll just do the easy route, which isn't always aligned with your best interests. But thanks for joining us, John. John Collins' information is up in there. I'd probably say shoot him an email is probably the best thing. He's a busy guy, so he does a lot of these, and he can kind of whip these estimates up pretty quickly for you guys. But yeah, we'll see you guys next time. And you guys want more information, go to simplepassivecashflow.com/cost seg for this webinar and the slides for this. And also throw up an article that John and I wrote together up there too. All right, John, appreciate it,
Cool.
man.
Yep. Thanks, guys.
Bye.
See ya.